If used correctly, the stock market can be an incredible tool for building wealth. Despite that, many people are scared of even touching the stock market due to a number of myths that we hear a lot. Today we're going to be speaking about these. We're going to be debunking some common misconceptions about investing. We're going to start off by thinking about why people fear the stock market. Many people believe that investing is only for wealthy people or experts. They are scared of losing money. That's one that we hear all the time, right? It's scary, it could lose, and that oftentimes leads people to not even learn and fail to take action. There's a lot of misinformation in the media and in social circles, and this can often lead to confusion. We all hear about companies that go bankrupt or financial crashes, but no one really talks about major successes unless it's absolutely exceptional. Then we have the truth, and the truth is that investing is one of the best ways to build wealth. Today we're going to be breaking down 5 of the biggest stock market myths so that you guys can start your investing journey and be correct about it, right? You can do it the right way. Is investing only for the rich? Well, we hear this all the time, and the fact is, this is false. You do not need thousands or millions of dollars to begin investing. The truth is you can start investing from as little as $5 or $10. You can buy fractional shares and build your wealth over time. Many brokers offer commission-free trading, which means that there are no fees, and low-cost ETFs. Investing early can allow for compound interest where your money grows over time. The truth is right now, investing's never been easier. There's so many platforms where you can do it, it's easily accessible online, and a lot of people make out like it's something which the average person cannot access or learn about. This is false. A lot of people invest and a lot of people do it successfully. Of course, be careful, research, but it is possible. Going back to that point about compound interest though, if you invest just $50 a month into an S&P 500 index at an average of a 10% return, you could have over $100,000 in 30 years. And whilst that may not sound amazing, from $50 a month, it certainly is better than nothing. Investing is not about how much money you have. Really what it's about is being consistent and early. The sooner you can start and the more consistent you can be, oftentimes the more rewarded you will be. We always hear that you need to be a stock market expert to understand how to invest. And again, this is false. You do not need to have a finance degree or be from an investment bank to be a successful investor. Of course, you need to be educated, you need to research, but just look at the market today. We have things like index funds and ETFs, which allow you to invest in hundreds of companies all at once. We have simple and long-term investing strategies which often outperform active trading. So think about this. If you invest over 30 years, 40 years, over the past 100 years or so, it's been proven that these simple methods often outperform a lot of active hedge funds. Even Warren Buffett himself recommends index funds for most investors. They are pretty easy and low effort. For example, if you invested $1,000 in an S&P 500 index fund just 20 years ago, it would now be worth over $7,000. And again, if you're buying into S&P 500, you are getting a stake in 500 or so companies on the US stock market. The stock market is a game that rewards patience, not complexity. You don't need to pick the right stocks to grow your wealth. Again, consistency is more key. Then we hear about the fact that stocks are too risky. Again, oftentimes false. Stocks can go up and down, but long-term investing reduces risk. You know, people buy a stock on Monday and they expect it to be up 100% by Friday. In reality, it could go down. That is obviously going to seem like a risk. If we take that over 10 years or so, it changes the game. The stock market has always trended upwards over long periods. You know, don't look for a week. If we look over 5 years, 10 years, 20 years, we see an upwards trend. Then we can speak about diversification, owning multiple stocks. This helps to protect against losses. Staying invested over decades smooths out market fluctuations because if you think about it, market crashes happen, then the market tends to recover. It may take a couple of years, but it does almost always happen. An example is that if you invested $10,000 in the stock market in 1980, it would be worth nearly $1 million today, even with crashes along the way. Again, what really helps is to zoom out and look at a stock market chart from the 1970s, and you'll see how much things are up. Risk is an inevitable part of investing, but the biggest risk can be not, I should say, investing at all. You know, look at inflation, look at the way that money is going. Money's becoming worth less and less. Not investing at all can actually create bigger losses than people even realize, especially over long periods of time. Then we hear that you need a lot of time to manage your investments. Again, this is false. Passive investing is a thing. Index funds and ETFs are great examples of this. They require little to no effort. Simply buy it and forget about it. Many investors only review their portfolio once every few months, if that. Automation is also a thing, especially in today's day and age. Auto investing and rebalancing. This can make investing completely effortless. An example of this, and a very good one, is that if we set up an automatic monthly deposit into an S&P 500 index fund, it will take less than 5 minutes, and it helps you to build your wealth on autopilot. For example, maybe a one-time setup, take $50 from my account every month. Over time, it will automatically go in and it'll help to build our wealth. Now, of course, do your research, think about where you want to invest, but it's just one example, right? Investing does not have to be complicated. There is definitely a set it and forget it approach that works best for most people. The market is rigged against small investors. We hear this all the time, big institutions have a massive share of the market, and there is some truth to that, but the reality is that small investors have the same opportunities as big institutions. Commission-free apps like Robinhood, Fidelity, and many more make investing exceptionally accessible. Fractional shares let small investors buy expensive stocks like Amazon, Tesla, or Apple, for example. Long-term investors outperform most hedge funds, and this is a funny fact. It is true. Most long-term investors get better returns than hedge funds and short-term traders. Let's think about another example of this. If you invested in Apple or Amazon 10 years ago, your money would have grown significantly, even without insider knowledge, just by how well these companies have done. Successful investing is not about being on the right side or the inside. It's about thinking long-term, thinking logically, and being patient. The truth about investing is that it can be for everyone, not just for the rich or for the experts. The stock market generally does grow over time, and long-term investing often wins. If you start small, keep it simple and be patient, this could be a very interesting journey for you. You don't need a lot of money to invest. You don't need to be an expert to grow your wealth. You don't need to watch the stock market every single day. Just try and stay consistent. The sooner you can start, the better your financial future could be. With that being said, guys, thank you so much for watching this video. If you enjoyed it, don't forget to give it a like and subscribe, share it with someone who might be able to learn from this, and I hope I'll see you soon, guys. Goodbye.